ladies and gentlemen. Oops. Cut it too close. Ladies and gentlemen, welcome to the 15th episode of the Futurum Equities podcast. You got myself, Stock Savvy Shai. We got the legend Daniel Newman. Wow, what a week. What a week. A lot of volatility, a lot of
Jay
risk
Powell.
off.
Started with Jay Powell.
Yeah.
Jay Powell speaks and the market still listens, despite the fact that maybe some of us didn't love it. I don't know. Everybody wants that pullback, Shai. You got that pullback, like a little pullback, especially with growth. Like the SPX, no, but like growth is pulled back like 5-10%. Some names a little bit more.
Yeah, I mean, I think it's we can all agree it was a bit frothy. I think that a lot of people forgot that the past 5 months the QQQ has gone up 50%, 50. That's not normal. So there's got to be some kind of digestive period, and I think that Powell, everything that the Fed does, it's pure theater. He says he's dovish one time, he's hawkish the next. It's all based on whatever POTUS says, in my opinion. I don't think the Fed is actually as valuable as they've been in the previous cycles. All that matters is rate cut cycles began. I'm pretty sure polling market has an 85% chance of rate cuts happening next month. And I think that we're seeing a lot of the risk on assets in the speculative names. I'm talking space, quantum, AI utility. A lot of these like biotech, small cap names are just running because this is kind of the first time in years where they're entering a favorable environment where the rate cuts are going to be a massive bottom line tailwind for them. But people are freaking out the last 2 days. I think their markets pulled the risk on, like you mentioned, has pulled back. Like I'm looking at I just made a post today right before this pod of the names that pulled back from recent highs. I'm looking Astera Labs, 26% pullback, Cypher 26% pullback, Oklo 22%, Iron 21%, Lemonade 21%, Open 20%, Rock Lab 18%. Like the list goes on. So like I think it's kind of a healthy pullback. If you look under the hood, it's been pretty bloody the past couple of days. But if you look at the indice, SPY's went down 1%.
I'm almost embarrassed to say it, but I really don't get Open. I know we've got a docket. I know you don't get to have a docket we got to get to here, but I don't get Open. I don't understand the idea of buying homes sight unseen. I've been a real estate investor. I've been absolutely burned by not even sight unseen, but just not looking closely enough at real estate properties that I've bought. The idea of like making a decision, being able to put in an offer, close a house, doing it that way. And then, like I said, with real estate and such a weird, like I get the meme stock thing. And I know people talk like Eric Jackson seems super smart. God, that one to me, it's like, I'm perplexed on that one. I'm super perplexed.
Well, I think that industry, we can stay on this topic for a little. I do believe this industry, the real estate industry, is one of the most frustrating industries out there for consumers. And it's kind of ripe for disruption. So when you think about AI, you think about what their capability is for every industry out there. And it probably is going to give somewhat of a cleansing on the most frustrating red tape bureaucracy industries out there. I'm talking healthcare, I'm talking real estate. Those are the two industries that are dinosaurs, that have red tape bureaucracy that limits any kind of innovation for the consumer. So if I do believe there's going to be eventually a name that actually disrupts the space, like a rational player in an irrational industry. We've all seen how much a story matters behind a stock, a movement. There has to be some kind of ethos behind it. Open Door, I don't see the pieces right now, but I also am rooting for it because they got a new CEO who came from a platform forward vision, Shopify. I mean, COO of Shopify, like what they did for the brick and mortar business, brick and mortar just kind of got innovated to become an e-commerce. So he saw that transition from industry need to get disrupted. Let's cut the fat, become a platform. Maybe he can do the same thing on the Open Door. It's a tall task. I think he has to cut a lot of fat. He has to repivot their strategy, but I do think there's a good story there, and we'll see. You have to track it because I do think at this stage, it's an absolute story stock. It's all a narrative. Eventually, there has to be execution. I think the price target is $82 that Eric or that Open Army is saying that's going to get to. Like, I think in order to get to that level, there actually has to be somewhat of a tangible pivot where you see some fundamental boosts, but it's also happening at the same time. There's a massive macro tailwind. So like, I think the pieces are in place for Open Door to actually be a disruptive player, but it's in a wait and see approach. But that's Open Door. I do want to kind of go back to something else that we want to start the show with, because This is like I started Futurum. What is it? Was it in June? I think this is the 3-month anniversary. Like we've wrapped up the quarter. So I think that it felt like a lot longer. I think that's a good thing. It felt like I've been bleeding Futurum blood for years, essentially. But yeah, I kind of want to ask you, like, looking back on everything we've done, like, what are your thoughts and like, what have you seen progressing on the Futurum side?
Well, first of all, it's been great to have you for the quarter. You brought a lot of unique perspectives into the business. We saw this great opportunity to, educate the market in a new way. It's also been fun to work on the AI 15, which I think we can, share. There'll be a little bit more to update there. The quarter rebalance is coming because that was the first thing we did. But it's really interesting because part of the whole ethos and thesis of the company really all started about how industry research is utilized in markets. And so I think that's one of the really cool things is when you and I came together, I've been a commenter on television and on media and built a bit of a social following, nothing like yours, over the years by taking the deep knowledge that we have. Futurum advises over 400 technology companies. And so the industry research business is heavily tied to two things: advising the buyers, the people that buy technology, and advising the vendors, the companies that create technology. And so we do tons of research, tons of data collection, tons of market sizing. We spend a lot of our energy understanding why buyers pick what technology they do. We recently launched an evaluative platform called the Futurum Signal that actually helps the markets understand how to select things like data platforms, service sales and marketing applications. We're doing one on agentic platforms. We'll have like 50 of these within a year. And the idea is like, look, buyers of technology and markets for technology are symbiotic. The numbers are what ends up painting the tape. And the tape ends up being the driver of sentiment and of buying decisions. And so we were right in the middle of this. One of the greatest and coolest things I do, and this is kind of how we met, was like I started occasionally joining your podcast on stock puts because I kind of told you, hey, I talked to like 100 CEOs or more a quarter from the biggest tech companies in the world. It's the coolest job. In industry research, we get to have so many of these conversations and better understand. But like you and I kind of came together on this ethos that like this kind of information rarely makes it to retail. Mm-hmm. So retail now are some of the most thoughtful and creative and also just, ambitious investors ever. The ones that literally read the job boards of companies every day to try to figure out what a company might be doing, right? Standing outside the offices, trying to have conversations with employees come in the door to better understand the business. Like this isn't only for institutions anymore. This is something that retail is doing now. And so with your amazing growth and following and our, the data, the intelligence, the market sizing, the interactions we had, it was like, look, taking non-proprietary information and making it also digestible for investors became the platform for Futurum Equities. And so Futurum Equities has been all about like, look, there's this something called the publisher's exemption. The publisher's exemption is basically what allows, companies like ours to write research, potentially, in creating things like sell-side research to do so. I mean, the most important thing is like, look, we do all these things. We have this great amount of information. We advise, we have relationships, business, commercial relationships with 400 plus technology companies. We don't ever talk to these companies about the stock in the sense of like, we're never like, hey, will you talk about our stock? No, absolutely not. Will we talk about the strategy, the business, the technology? Do you help us do things like market sizing or better understanding the business, the competitive intelligence? Absolutely. We do that all day long. And we publish a lot of that stuff. A lot of that stuff is published publicly for consumption. And it's great research that investors can use to complement the sort of traditional market research that you get from like equities firms. So on our side, though, like where we've really expanded into equities is like, look, the message is very similar. There's a lot of overlap in these areas. And so we felt that we could really bring signal, both metaphorically and literally with our products through the noise. You offer a daily signal. Again, it's thematic. It talks about your trends. And then the other thing, and I kick it back to you, is like, in our world, I don't hold positions in almost any of these tech companies. I say almost because occasionally there's either we've taken investment as it's been related to like Grok, like a startup like that. They didn't have money. And so we actually did advisory work for stock. And you'll see anytime I talk about that, I'll specifically mention that, like, hey, shareholder. And, I think that's really important too. So I think a lot of great things are happening. Of course, as we built this show, I've also opened up quite a bit more about how I invest. And because I can't invest in a lot of these technology companies where we might have those great relationships with executives, a lot of interactions. And even though often you can invest as long as you don't trade on anything that's proprietary, the problem is it's like too fine of a line. So I just don't play in that sandbox. But the bottom line of it all is, like, we're moving really fast. I think you've done a great job creating and sharing information with markets that has, high alpha and value. You've shared your experiences, but I also think it's super important, like, in what we do is, like, look, we're it's information, it's entertainment, it's publishing, it's editorial, but we're not advisors. We are advisors to the industry in the sense of, we have research and data, but we're not advisors to investors. We are kind of sharing what we think, what we know. It's a perspective. But as I always say, and I think now we even have that little ticker and it says, do your own research. It's not investment advice. If people happen to follow you because you do great things, Shai, I mean, what, 500%? Amazing. It's an amazing return. People might pick on you because, you're not the most technical in every area, but you get themes. And there's a lot of value in that. And you know what? Winning doesn't always bring, not everybody loves a winner, but I love a winner. So congratulations on all your success.
No, I appreciate that. And I think it's really important to, like, we never really broke down differences between, like, Futurum Equities. And I think that we really never talked about I call this the admin side of what we do, because it's just telling you guys facts rather than going really what's happening in the super cycle industries and where the puck's heading, where decision makers are actually essentially putting this capital where they're heading towards and where the alpha is in the future. So I think that it's really important that we went over that. And I think for me specifically, like, a lot of people forget I started my Twitter in 2023. Like, I'm still a newbie, and, like, I started all these positions that I talk about, like the Palantirs, the CrowdStrikes, Rock Labs, IonQs, etc. Like, I've been publicly sharing these positions since 2023, years ago. I started.
Don't you up? I mean,
ago.
this is the personal side of your business that you do.
Yeah.
But, like, don't you kind of send out updates to your followers on things that you're doing and changing?
Yeah, it's everything's transparent and everything's validated by a third party, which is vital because there's a lot of people out there who have an Excel sheet and updated, and that's what their performance is. There's no validation at all, except for an if formula error. Like, the validation for my stuff is by an actual third party.
Is you are whooping my rear. Now, again, I have a limited subset of companies that I can invest in, but you have absolutely whooped my ass.
Well, we're aligning on some of them. Like, I got into Cypher for a tracking position this week. Yeah. Like, I think the AI utility is a
down 20% since I opened that one. So go me, but I still do think that's a real play. I think my conviction's is higher than the volatility.
Yeah, I mean, I also think that those names, the Iris Energy, the Cyphers, the Wolfspeed, like, they've ran so much. And I think it's because these deals that we're seeing, these AI deals like Oracle, OpenAI, NVIDIA, these are video game number-like deals. And I think everyone is realizing soberly that we just don't have enough data centers out there. We don't. And eventually the head's going to hit the wall on the power side of that equation. So I think that for you, I would love to hear your take on, like, what made you cross that boundary of, like, I need to get part of this AI utility theme, and I'm going to get into Cypher right now.
Yeah. Well, listen, this is a place we have no, advisory relationships with these companies. So it's fun that I, could actually play here at this point. I see the mega trend. It's just that simple. You listen to the cues. The cues are saying We can't build capacity fast enough. You look at the deal with Nebius. You look at the deals with CoreWeave. You start to just hear the constant, humming from the CEOs of these hyperscalers that they can't go fast enough. They can't build enough capacity, can't build enough energy. We know that energy is one of the gaps between us getting to where we are and where we're going.
Mm-hmm.
So I disclosed both of those on this week. I opened some options positions about a week and a half or two ago with Iron and Cypher.
Oh, I didn't know about the iron one. Interesting.
Yeah, I had Iron, but it was just well out of the money put spreads. And it was basically just collecting premium because I don't see them coming back 50 to 70%. But the volatility is huge. So I love those kinds of trades. I play those kinds of trades all the time. The Cypher one, though, is like I said, I felt like Iron had run a little bit. And, I just have this is like a mental dissonance I have, but I just have this mental dissonance when something's run too far. I just I can't like Robinhood. I bought a lot in the 30s and I felt great about it. But as it got into the 80s and 90s, it's like there was tons of alpha there still, apparently. Now, again, it might pull back in some sort of meaningful correction, but I just couldn't buy it anymore. And Palantir was the same thing. After I went from 9 to 50 and I got out, it's like, oh, I can't take a position in the 60s. It's like, I wish I had, By the way, this is like a handicap for me. Please do not this is one of those where I'm like, if I wasn't clear enough, it's not investment advice. This is not investment advice. I'm just saying, personally, I felt like Iron had gotten a little bit more of the sort of upside. The analysts had started making the really bullish calls. And by the way, we got in on Cypher. The Google call came pretty quick after. It was just that shelf and offering. And then, of course, this being kind of one of the worst weeks typically of the year, every year, while September hasn't been that bad, this tends to be the worst of September. So I just think overall it was kind of a culmination of things. So, I'm not up on that one right now, but I actually doubled my position in Cypher. I bought in early in the week and I bought more later in the week when it went on sale again. And I might keep adding because, like I said, I just feel like this has a ton of upside because the play is that, we need more capacity, more compute, more energy. So it's like these companies are super interesting.
So, I'm very green in the crypto space. I'm actually dipping my toes even more right now with it. Ethereum specifically, but on the AI utility trade, why I started a tracking position for Cypher, for example, it is kind of it could be a KISS method, a keep it simple, stupid, where there's clearly, we know this, there's an AI shortage. There's going to be an AI shortage for what I believe years to come. If you believe Lisa, you believe what Futurum, what we are saying, we are probably a quarter of the way on that AI build that we need for that first wave. So I think the Cypher, for example, it's a leverage proxy on that AI shortage where it's going to soar when compute demand is going to continue to outpace the supply for the next couple of years. And there are going to be these leverage plays for that. But I still don't know about the long-term positioning of it because eventually the hyperscalers are going to catch up on the supply and demand, but I just think we're so far away from that. I also I'm still digging into the space more. It's kind of complex, but I like Iris more. I really do. I think that
Iron?
Iron. Yeah, sorry.
Sure.
Iron. I like Iron more because they are less of a landlord and they kind of have their own AI cloud with thousands of NVIDIA GPUs already.
We're really talking about Bitcoin miners converting their GPUs, right?
Which is exactly. But it's not that difficult as you'd assume. I'm looking into it. It's actually kind of a flip of a switch a bit, where it's not a massive capex holdover. It takes time, but like you mentioned, Iron has just ran, and today,
where's value created? This is the only thing that they have to be careful. I think the real value for me, Shai, is the energy they're going to create to support this.
Well, they have the cheapest
bare metal. The question though is like in Nebius actually has done good because they've put a lot of value at. They're really focused on helping enterprises deploy AI and making it more CoreWeave is pure capacity, and they've done great, but it's
it's not the cheapest. No, but it's true because that's why I like Iron so much, because I think they have, I want to say it's 3 or 4 cents per kilowatt an hour. It's among the cheapest in the industry. I want to say Cypher's 5+ cents, but Nebius, they have the best economics for that power component of the data centers. I think that's why you're seeing the Azure deal, for example, like why they chose them. And I think that it's funny because like in software, there's specific KPI metrics you need to track. I think for these AI utilities, that is the KPI metric to track. And I also am a little worried on Iron only because there isn't a large deal yet with a hyperscaler. That's my only caveat. I was like, why not? Like right now, like what is the holdup? We have Google with Cypher. We had Microsoft with Nebius. Like, where is Iron's deal? Like, I'm sure it's coming because I think there's gonna be the hyperscalers right now. They have the insatiable demand for their compute. They don't want the capex overhang in the immediate. They need a band-aid essentially. They're going to go towards these AI utility players. But I'm wondering like why it's taking so long. But either way, what is even down right now? Last time I checked, Iron was down 12%, which is
kicking the ass today. Yesterday it was
is.
like I said, but this is like low revenue, high volatility, conceptual companies that have not necessarily crossed the chasm yet into fully legitimized. But like these deals that they like the Cypher with Google and that deal, like there's a lot of legitimization that happened very quickly with that.
I think they validated the space. I think a lot of people are still like viewing them in the lens of a crypto miner, even though they're clearly making the pivot towards AI. There was still like, maybe it's just a narrative. I think these hyperscaler deals validated the space. And I think that's, don't be surprised. Like when we're doing our Futurum AI 15 rebalance, it's going to launch this weekend, Sunday during the future. Sunday night, you're going to see our new list. We're also going to go over our performance on the first 3 months. And spoiler alert, like it was pretty good because we had Oracle before everyone realized Oracle was this new cloud play. We had Astero Labs, we had Broadcom, Uncle Sam, like we had Palantir to continue up to the right. But we kicked some names off the list. There's 4 names that are actually not on the list anymore.
Yeah,
and
it's probably worth mentioning too, Shai, that one of the things that we're trying to do, because in the first bout of this, we were really trying to it was purely companies that we thought had a lot of AI upside. I think we're also trying to balance a little more thought around alpha, meaning like companies that we think, because some companies are still awesome, but they've run the course, meaning like maybe they found sort of a stasis on their pricing. And like you and I don't have confidence that the market's ready for the next wave of upside on these. Because like, some of them also are maybe still have really great AI stories, but we think it's going to take more time for them to play out. So knowing that just like a CEO of a public company gets evaluated on the quarter, we are trying to work on the AI 15 to make it even more friendly for that sort of tracking number as well, where it's not just about like what companies are doing great AI, but also which companies have real potential upside from here in the AI trade. So, we're challenging ourselves to do better because like, we had a couple of names I think are good companies, but they just, they were kind of priced high. And then of course, where did we go wrong a little bit? Like, I think we probably underestimated how much disdain the market has for SaaS right now.
No, it's true.
Like there's some companies I think are going to be really important to enterprise AI, but like people right now are just super bearish.
Well, for me specifically, my perspective is I underweighted the longevity of stage 1 of AI. I thought it was going to be kind of a couple years, and then stage 2, the applications are where you really make them hidden gems. That's where I got wrong on the software names, because I thought the software names, like we're in year 3, year 4 of the ChatGPT moment for AI, and I think that was where the transition was going to happen. I think that stage 2 of the software SaaS is getting punted a couple more years. I think that this building the rails or building the cities for the AI economy is going to take a lot longer than I anticipated. And it's validated, though. You need to do that. And I think that right now, the key to making sure we're not building empty cities is the inference boom that we're seeing. So that's also making the stage 1 winners like even longer, because there's a lot of inference winners. And you went on Fox this week, you were talking about the tokenization trend year over year. It's insanity. It's 10xing year over year. Like, you want to talk a little more about that?
Talking about it, I think it was one of the top technologists at ByteDance, I think was, and I can go back and find the clip, but he basically was talking about 50 trillion, the expected token consumption in 2025. 500 trillion is in 26. And orders of magnitude could see, 10 plus orders of magnitude. I think it could be higher than that because I think, we're really not, enterprise AI is super young, like very, very early in terms of real adoption. I'm not talking about companies where someone's using ChatGPT for their day-to-day. I'm talking about where like a fully deployed agentic platform, that has replaced a whole bunch of the SaaS software and is doing thousands of agents working concurrently with each employee. Like that has not happened yet, but that's going to happen. And then of course, robots, autonomy, vehicles at the edge, like all of that stuff is not necessarily accounted for either. So as that all takes off, you're going to start to see a flip from this kind of training powered infrastructure build to the inference powered. We've already talked about that trend line a lot, but like this is also what's driving the energy play, the energy utility and AI play. This is what's generating, this constant CapEx demand play. And this is, what's going to continue to spur more bullishness about companies like NVIDIA. I mean, despite the fact that, some people look at the whole NVIDIA OpenAI deal. It's probably an interesting and I actually shared something about this. Like, companies like venture arms of big tech companies have been investing forever in startups that could benefit from the utilization of their technology. Now, OpenAI is a higher profile company with higher needs and demands, but like literally that's been a trend line for as long as I can remember. So the idea that NVIDIA working and investing in OpenAI could lead to OpenAI needing to use some of the money to purchase more NVIDIA is, it shouldn't be that weird to people. That commonly happens as part of a build out. That might be why a Salesforce Ventures picks a company because they think they can help them with key marketing or sales technologies. That might be why Google Ventures, because they could help them with ad technologies. Like they pick companies and put them in their portfolio, oftentimes based on the fact that these companies could benefit from building on their platforms. It's not actually that weird. It's just so high profile and visible right now that it is a little bit weird to people. So that was one of the things, by the way, that, kind of bugged me about that whole deal. But look, in the end, right now, the skepticism will be there until consumption grows. So the token consumption and then the ROI consumption, until we can basically go back and say there's like 30 big companies. Like we look at like an Oklo. It's like Oklo is a great story. Oklo has no revenue, like not any, zero. Okay. $20 billion in zero revenue is a bubble. That is a bubble within what I'd call is not a bubble. Google at 28 to 32 times forward with its ad business, its data business, its autonomy business, its YouTube business, like all the things it has, and a massive cloud business, not a bubble. Nope. And I think this is like where people can't even think about two things at the same time. It's not the same thing. So, the train keeps rolling. There's a lot of positivity and opportunity, but I still stand by like even last week's theme. Like I still think there's some pullback coming, but the AI trend in the long term is very, very much intact.
Well, you mentioned a really interesting point where it's hard for people to say there's a bubble in one aspect of the market without saying it's a bubble in the total aspect of the market. AI, like there's a thing, like when people look at the PE is a perfect example. Forward earnings multiple. A lot of companies, a lot of investors used to just trust that one metric if something's overvalued or undervalued. If you look at Broadcom right now, for example, they're trading at 42 times earnings, forward earnings. That's pricey for them traditionally. If you factor in their PEG ratio, price per earnings for growth, like how much their earnings are actually growing, it's at a 38% clip. That means that the PEG ratio is at 1.2, 1.1.
Which is just above undervalued.
Exactly. So like they are justifying their valuations because their bottom line is expanding at such a rapid pace. So that's why it's really important to like not look at one piece of the information or formula, look at the whole formula itself because it says it's a completely different story. But I think a lot of people out there, especially on FinTwit, they missed out on this. They completely missed this rally. It's one of the most hated rallies out there, especially since April, when the macro tariff wars, everyone got scared out of their positions. Spoiler alert, we did not. We actually doubled down, essentially. But a lot of people were petrified. So they missed out on that.
There's a lot of political here. There's a lot of political soup to eat, too. I mean, the President Trump is probably one of the most either loved or hated in history, meaning like the strong feelings that people have. There were a lot of people I like, on this site that just absolutely could not wrap their head around the idea that tariffs may not blow up the economy and that it could end up working out. And they basically just all ran for the hills. And even still, they're still waiting because it's like it's, you know, they say about like shorts, like, that the market can be, a market can be irrational longer than a short can hold their position. It's the same thing. Like they're being irrational. This is the people that are like chugging Tylenol right now with their pregnant. Like, look, I'm not a doctor. I have no idea like if that's a good thing, but Tylenol did tweet like, don't take our stuff. I mean, there was literally a Tylenol tweet. I think that's real. I think that's been legitimized. Like that was a real tweet from Tylenol, like that they never recommend taking their products while pregnant. Now, I'm not a medical professional. I'll say that twice, but like, I don't know. I might just like say, look, even if it's 1% or 0.1%, I wouldn't want to try it. But like, there's people like they talk about like the derangement syndrome. Like the derangement syndrome is so significant with people that I think about half the people that got spooked out just absolutely wanted the tariffs to be a failure. They wanted the economy to crash, and they did not want to get into the market because they were so committed. They were pot committed to the negative narrative.
Well, I also think it's a lot of people who didn't do their own research. Like, if you knew AI, you knew you can't pause the amount of CapEx spending that was the momentum was carrying into that April moment. Like you just can't pause. You have to continue, push down the momentum, push up the momentum for getting all the tools necessary for you to fulfill your AI max potential in your enterprise. Like that was not going to go away unless Taiwan gets invaded and there's no more AI factories. That was the only real reason of like, maybe there's an issue on CapEx spend, but anything else, the party's going to continue. Why is that? Because it has to. We're entering this efficiency era that is not only going to benefit these hyperscalers, these enterprises who make sure they win in this race. And I think that the opportunity has never been greater. That's where you're seeing a lot of these hyperscalers overspend what they originally commit because they can't afford to underspend. They can't afford the risk on underspending is far greater than overspending. Zuckerberg went on a podcast last week highlighting he's probably overspending on CapEx, but guess what? They have the luxury of how they're printing.
Yeah. Also, the alternative. I mean, they make a lot of money, but the alternative is missing the trend and falling behind, and the trend's moving so fast. Now, I do think it's also important to zoom out. And I was at Milken and listened to Secretary Bessent there. And it was in that moment, which was not far after the April bottom. So those were tougher times. Everyone's accounts were looking a little uglier. He basically said there's two choices, and fiscal, a fiscal responsibility is not one that anybody on either side of the political aisle wants to choose. Nobody wants to cut costs. Nobody wants to slow spending. Nobody really wants to fight for that 2% inflation. The only reason some people were fighting the idea of lowering rates and the whole independence of the Fed was just because they hate Trump. They just don't want him to get I swear it's not because like Elizabeth Warren for the longest time has said rates are too high. Like it was never a one-sided thing. Everybody wanted rates to come down because it makes people's homes cheaper. It makes cars cheaper. Credit cards become less expensive, and those dollars end up getting put back into the economy. We are a consumption economy, and so we are also we are not spendthrifty. We have no intention as an economy to ever return to fiscal hawkishness as a political policy stance. So what are we going to do? Well, we have to outgrow. So if you look at that thesis of having to grow faster than we spend, the only chance is that we have to keep quote unquote pumping the economy because that's what's going to end up driving. And the only way people can build wealth against high inflation is being in high growth assets. If you're only getting 5 or 7% per year, you're barely keeping up with inflation. You can tell me it's 3%, and I'll tell you I have a bridge for you. There's no 3% anywhere. You go to dinner, go rent a hotel, go grocery shopping, get your car insurance, health insurance. Nothing's up 3%. It's all up way more than that. Mm-hmm. But at the same time, Shai, if you put a dollar into the QQQ 5 months ago, you got 50%. If you put into a lot of other growth assets, and if you just tracked your shares, you'd be up 500% in 3 years. Like people can grow against a backdrop of that kind of inflation when you're investing like that. But it doesn't address the 90% of the population that doesn't have portfolios. So it's a whole different issue. I'm not here to solve that one. But what I am saying is like the being in the market, he kind of clearly sent the signal. And then Trump talk about like sending a signal was like, what did he say? Like buy stocks, like right before they rich. I mean, look, I don't know, but that seems to me like that was funny. Do you actually remember the day? By the way, do you remember the day that they put out something? It was like a tweet about something, and then like the market ripped, and then they said never mind. The pause. It was the first pause on tariffs. They were going to pause them.
Oh yeah.
And the market absolutely ripped, and they said, just kidding. And it went right back down. And then the next day they ripped it again. They basically decided, and it was like they were actually like, the administration that does not care at all about the market actually cared about the market. But every president does, because the American exceptionalism is all about kind of capitalism. Like we can argue, we've obviously got a bit of a internal war on our hands in the U.S. among the demographics right now of the capitalists and the Marxist, which is super interesting, because what's being taught in our schools is more closer to Marxism than capitalism in many ways. But like presidents run on like, what did the market do? Like, and it's not a left or right thing. It's both. Like people love the USA. They come here, they flock here for the opportunity to be exceptional. So it's just the setup, Shai, is all about continuing that run. Got to spend, and spending goes right back into the companies that we're investing in.
Well, that doesn't surprise me, because I think that you could probably back the sentiment up. But a lot of people will be surprised of how many CEOs wake up and check their stock price of their company. They do it on a very normal basis, maybe every single day. The president is the CEO of the U.S. government. What does he do? How do you track his sentiment, his performance? It's a stock market.
Did you see the freaking tweet from Trump sitting in his desk showing Intel up X%? Like literally,
no,
it's on his desk. It's Intel like up 50% since we made an investment. Like he's literally taunting the population. I mean, the people that because I was the one to say that, like, look, I'd rather have it be taxpayer equity than taxpayer giveaways. I mean, at least there's a chance the money comes back. Either one is like not ideal. I really don't want our government to be, but like sovereign wealth funds. I mean, that happens everywhere. Like, pick your winners. And by the way, I just got to say this: if anyone's, I don't know if anyone's listening to the show, but if you are, if anyone else wants to talk to me about the Intel TSMC thing, remember TSMC only exists because the Taiwanese government funded its existence. Okay, so. Yes, now it is a juggernaut, and now it's one of the most successful companies in the world. But over 30 years, between the tax incentives, land, grants, money given, and of course, all the business that was brought through the policy that was created, there was like $100 billion worth of value. Okay. And so the fact is everyone's like, oh, I can't believe we're socializing. What we're doing is we're investing in the most important technological capability that we could ever need to make sure that our society remains the most prosperous economy in the world, even if something happened, say, to Taiwan. That's it. I'm not here to be a fanboy of Intel. I hope Intel does well. I like American companies doing well. I want to see an American foundry do well. But what I really want to see is that the U.S. doesn't become so codependent on any other country that we cannot function and be able to make sure that we maintain our global economy and our economic leadership.
Yeah, I mean, you said it best. First off, having a successful foundry from the get-go is very difficult. It's capital intensive. It takes a lot of red tape, bureaucracy to get it to the finish line. You need help outside of your internal organization. So like TSMC did it. Why not Intel? So I'm all for it. And I also do believe there is what is discounted is the national security risk of us losing in AI. It's like we hear ourselves talking about this all the time on this is going to change the world forever. Every single part of this world, not just tech, not just enterprises, every single part, workforce, your aunt who lives in Mississippi, your uncle who works the boats in Seattle, like everyone is going to be impacted by it eventually. So in order for us to maintain our dominance that we have in the world, you need to make sure you are leading this next great race. And that's what AI is. It's the next arms race. So everyone trying to poke holes on these little incentives that we're doing on making sure we have the tools necessary that worst case scenario, if something happens, we're okay, is ridiculous. It's short-minded. It's short-term thinking. They're not looking at the wide scope of what the world might look like in a couple decades if we do lose this. If everyone thinks like, oh, the it could be like the moon race. Like it's so different than the moon race, guys. Like it's so different. This like massive risk that we have in the national security front. And I think that we do have a lot of like I love the lot of deal flow that we're seeing, because I think that is a big rock for this current administration. Is like, this is actual national security. We have to make sure we're ahead of it, and we're going to incentivize a lot of these foundries, a lot of these like U.S. shore companies to make sure that we do this right. And luckily for us as well, Daddy Jensen is all on the U.S., the West. Like this is our, like we have NVIDIA. Everyone else,
he still wants to do business with China. He's been clear,
yeah.
but I think he's embracing that if that does not happen, he's going to go out and diffuse NVIDIA technology everywhere else. I do want to give a parallel though, by the way, because you said it's not the moon, but what it could be is advanced manufacturing. What it could be is pharmaceutical APIs. What it could be is rare earths if we don't manage this now. Meaning, like, we basically built a unbelievable codependence on China for all those things. We can't do advanced manufacturing here in almost any industry. We can't do pharma APIs. We have very little material to make the drugs. So even if final products are assembled here for the pharma drugs, most of the key ingredients, not the API like a software API, the API as in the key ingredients for pharmaceuticals, are coming from China. Very little from the US. Probably know this from your healthcare days. And we don't have rare earth magnet. And so like you see some of the potential investments. We heard about the lithium investment this week. Yeah. It's like, we have to get out in front of this. Like, we can't do EVs. We can't do this stuff because right now, this is how China still has a hold on us on some things because we just can't get it. We don't have it. We can't get it fast enough. And so it's a weird codependence between us and China. Like, they need us for things. We need them for things. And so we still kind of find a way to do business. But at the same time, the strong political posturing of two very, very convicted leaders, conviction, not convicted felons. Some people may say that about Trump, but I don't know. I don't know what to say about that. But anyways, conviction in their beliefs has led to very strong posturing at times. But we're still getting things from them, and they're getting things from us. And by the way, they need our economy. Like the U.S., we are the consumption people. Like, we just buy crap. I mean, we spend money like no other part of the world, and so they make cheap crap that we buy. You know that old joke, Shai, about the dolls? Remember that joke about you need $3? Like, whatever he said. You ever hear Trump talk about that? They have $20. They don't need $20. They need $3. He made a comment on the jet. But his point was like kind of well taken. Is like, why do the kids have $30? Like, what in the world? And by the way, why are dollars, instead of making like $100 doll, like a really well-made one that the kid can play with, we need to get them $10 plastic dolls full of microplastics and chemicals and all the other things that, because we need to get more cheap stuff from China because we are consumption connoisseurs. And so, I realize I'm a little bit on a political diatribe right now, but it is what it is. I mean, we've created this monster, but they need our economy. And we need them to make stuff for us because we can't do it anymore.
So let me ask you this. The year is 2030. How different do you think things will be?
2030. I mean, we're going to be just standing up some of these factories. Like, even if we were to re-onshore, and by the way, it's super interesting because obviously Trump won't be in office anymore. So yeah, what happens in the next election is going to be really important to see what kind of policies stick and what kind of policies might roll back. But I do think AI will be prolific. I'm super uncertain about the AI impact on jobs. I'm way more bearish about that than a lot of people are. Like, a lot of people do not think jobs will be impacted. I think they are going to be greatly impacted. I'm actually training a model right now to replace you because I can just build a robot, Shai, and I can train it on all your content, and I can just have a podcast whenever I want. Serious, like a lot of stuff we do. I mean, we got to figure. What we haven't, like I said, what we haven't figured out is like, what's the next level of our own evolution as AI evolves with us. But I mean, I don't know if you've seen some of these stats about like Gen Z and like how they're building relationships with AI. Like, I think these kids are going to like marry robots. I really do. Instead of humans. I think that's going to happen. I think we've already like overly committed to sharing with big tech through our own desire to chat with LLMs and robots. Like, God, it's funny how prescient the movie Her was.
How long ago? That was like over 5 years ago. If you guys don't know this, it was like the great Scarlett Johansson and Joaquin Phoenix, I think was the actors in that. So wow, like, he fell in love with a voice, an AI robot. I think it was a voice.
Do you actually know how long ago that was? It was 12 years ago. That movie came out 12 years ago.
20? Jeez.
13.
I was in college. Wow, I had no idea. That's crazy. Wow. So that was
But I may end up looking more like Ex Machina. I'm not sure, but like.
Well, regardless, AI is going to be so intertwined in our lives. I think that's what we're getting at in 4 or 5 years. My question, though, is I think we've seen a plateau on model leaps the past 3 or 6 months. And that's making me realize that maybe AGI is actually a ways away. Like, I think that there's somewhat of a difficulty right now in improving the model quality at the pace they were from 2023 to 2024, for example. Now at 2025, it's kind of like feature ads rather than, whoa, this is drastically different. Do you think there is, like, what's your read on why it's kind of plateauing on the delta of leap of quality on the models, and how quickly do you actually think that AGI is going to come to reality? Is it 2030 or is it longer?
Yeah, I'm not smart enough to even predict the AGI thing. What I will say is I think we've seen there's a capacity related constraints, there's research related constraints, talent. We see the war on talent. What we're seeing is a little bit more incrementalism from generation to generation. Some of the great tactics that we got with test time compute, the small value we did get from DeepSeek moment was like how we can sort of use and create inferencing in real time and sort of separating the engines to handle kind of queries that require low amounts of reasoning, more of the ones that you can get those instant responses, and then deeper research and reasoning, longer responses, better responses. All that stuff is materializing. The other thing is data. We're running out of data to train. We've trained on everything that's out there to train on. So now we're into like creating synthetic data. Because obviously, I was thinking a lot about this. Like at some point when I create the bot of Stock Savvy Shai that does all the pods, and then all the pods were created by a bot, then at some point in the future, there's really no human input anymore into it. It's all synthetic because it was all taking your original input. Now we create all the synthetic content, then we train on more synthetic content to create the next generation. So it actually becomes like many, many times removed from human inputs. But like we are only creating so much, and so much, by the way, what we are creating now actually is created by AI. Like so many things we're creating, kids in schools and research papers, even if they have contributions that are coming from humans and data, it's then being soaked up and written using an algorithm. So it's really, really interesting. But I think the challenge is making the model better enough. It's not just like iPhone 16 to iPhone 17 anymore, that there's something really meaningful and material. That's why I put a lot of my like flipping to enterprise. Like I think enterprise might be that next wave, is because like consumer will continue to advance. But I think it might be at a bit more of a smaller clip, but the opportunity to really implement this stuff into business and displace the software industrial complex, I think that's really palpable.
No, I agree with that sentiment as well. And I actually kind of want to talk about go back to the stocks of it, because I think we went over a lot about society, political, where AI is heading. I kind of want to go over where I've been adding a ton of capital in last week.
Let's go.
Amazon. I think Amazon is surprisingly the worst performing Max 7 name in 2025. And I think a lot of people are confusing why that is. When you think about the biggest lagger among a group, you think about that AI tsunami that's coming. They're going to penalize this company because of whatever reason. That's why they're lagging. For Amazon, it's my interpretation of what's happening with Amazon is not that at all. I think they're going to be a massive AI winner and beneficiary of where society is heading towards. I think they've had a couple fumbles, some like going too hard on Trainium, not getting enough compute necessary to fill the AWS demand. That's where the backlog is significantly higher than what their AWS growth is. So I think there's a lot of AWS lagging growth compared to Azure and Google Cloud that's kind of hurting them. I think there's definitely a near-term tariff noise that's also hurting them as well. But if you look at the bigger picture with Amazon, they are positioned probably just as well as Google, just as well as Meta on monetizing AI across so many touch points of the economy that nobody else can really even fight for that. And what I mean by that is, let's just talk about their ad business. I think a lot of people are just like severely discounting their ad business, where it's at a $60 billion run rate, I believe now, or it's a $50 billion run rate. It's growing 20% annually. So when you think about their growth rates, that's higher than YouTube ads. That's higher than Trade Desk. That's higher than Meta. So there are the leading ad business growth at that scale, and they have 35% EBIT margins on top of that. So it's one of the highest return businesses in what I believe is the entire digital ecosystem right now at that scale. So the big difference between what makes Amazon ads so unique compared to the Googles and Meta is the point of purchase right now. I think that when you think about ad spend, you think about, all right, they're monetizing attention. Google monetizes search via attention. Meta monetizes impression via attention. Amazon sits at the point of purchase right now. So they're kind of selling conversions rather than intention. And I think for where the world's heading, especially in agentic AI, that is the lever that's going to be pulled on monetizing ads. So I do think it's a $50 billion business. If you think about 35% EBIT margin, I'd almost say that's a $500 billion business alone, maybe. But you're not even including AWS or the e-commerce side of their business, and the physical AI is going to be a massive lever to be pulled on the e-commerce business. And AWS, I want to hear your perspective on AWS, because they've been known as the king of cloud for years, and now Azure has that open AI relationship that's benefited their reacceleration. And I think that you're seeing Google Cloud just absolutely destroy the past year or two, maybe because of their TPUs, maybe because of their distribution, whatever reason. The Google Cloud is just being one of the hottest names out there.
Yeah, there was a reinflection on the clouds that happened with AI. That certainly, but AWS is still the leader, and I think it's somewhat undervalued. But it was a little slow out the gate, and it got hit for that. It was slow, mostly on buying its capacity. It didn't spend enough. It didn't spend enough quickly enough. And there was some major impacts to that in terms of its ability to deliver. What I will say quickly is I've been very impressed by the ads business, but my lever, if I was pulling a lever on Amazon, has most to do with the fact that they just have a ton of cost takeout they can do with physical AI. The robots and drones and delivery trucks, all the autonomy that could be implemented into that business, because they have so much cost. They are the big they have real facilities, real headcounts. I mean, they're like 1 million headcounts in that company. It's massive. And of course, that's not good for the other side of this with the whole "what are people going to do" argument. But that is that is the reality there. I want to leave with one big thesis for the audience that I'm super focused on is don't be fooled by any. I'm going to just beat the drum one more time on all the zero sum stuff. This OpenAI NVIDIA thing brought this whole thesis that basically OpenAI is going to double, triple, and only commit to NVIDIA. I promise it is still committed to building its own infrastructure, 100%. Okay, it is all in, but it's going to take 3 years or 4 years before those chips are going to be usable. And so, of course, they want to build a great relationship with the best hardware and software provider on the planet to be able to build out their AI ambitions. It's in our forecast over 4 years. Has $583 billion of AI infrastructure, and very importantly, of that, about 70 to 80% of that's still going to be GPUs in 5 years. So even though the GPU acceleration slows down, and Broadcom will see that great growth, and you talked about that earlier, that NVIDIA and Broadcom can coexist in those accounts. And by the way, I think Marvell had a good week too. They actually got out a little bit in front of it and started explaining their position, which I liked. And I talked about that this week on Fox Business. I had a busy TV week for sure, though.
You did. You killed it this week. I actually was in my office. I always have it in the background. And it's funny. You popped up. I was like, oh, I got to listen. But yeah, I mean, we're at the top of the hour, guys. This was, I don't know. I like this episode. I think before I love every episode. I'm not saying I don't like the previous ones, but this one, I felt like it was grounded because we were just trying to think about a lot of the future, where things are heading and how the pieces are moving, where it was just really wide scoped. I did appreciate it. It's episode 15. It's exciting. So Thanks for hopping on. Any final words, Daniel?
No, man. We'll see everybody soon. We appreciate you being part of the community, and stick with us. And if you don't get us here live, we're on all the platforms: Spotify, Apple, YouTube. We got a YouTube channel. It's starting to grow. Like, even though you and I have given really no love, put no water on the grass, the grass is still looking pretty damn green.
It is. It's improving. So that's great to see. And tune in next week for episode 16. Have a great weekend, everyone.